Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. Last two videos I have explained you about the subject, about the topic financial management. In the first video I have explained the meaning of the term financial management, what is risk, what is return, types, everything I have explained in the first video. The second video I have explained you about the different financial instruments like debentures, preference shares, equity shares, like that. This is the third and last video on theory of financial management. Next video I'll start the problems on financial management. In this video I'm going to explain you about the cost of capital, the importance of cost of capital, classification of cost of capital, and computation procedure of cost of capital. These are the things I'm going to explain you, because without understanding the concept we cannot be able to solve the problem. Problems are based on the concepts of this cost of capital which I'm going to explain. So watch the video till the end to get the complete command. Don't ignore the theory part. Remember, this is the foundation for problems. So take the screenshot of the points which I have written on the board, then I'll explain all the points regarding cost of capital. Now, first of all, I'm going to explain to you about the meaning of the term cost of capital. The cost of capital is the cost payable by the company on the funds utilized. So from whichever source the company has raises the funds, the company has to pay the cost. That means funds are not freely available to the company. The company has to pay the cost of the funds, and the cost of the funds is nothing but the cost of capital. Simple example, when the company issues debentures, the company has to pay interest on debenture. When the company issues preference shares, the company has to pay preference dividend. When the company has taken a loan from bank, the company has to pay interest on the loan. Similarly, when the company raised the funds through equity shares, it is obligatory on the part of the company to pay equity dividend. So this equity dividend, preference dividend, interest on debenture, interest on bank loan, these are all the cost of the funds utilized. And this cost of the funds is called cost of capital. So in simple words, it is a cost of company's funds, first of all. Secondly, it is a rate of return that firm must earn on its investment. See, if the cost of funds which are used in the business is, let it be 20%, then the company must earn a return of more than 20% on its investment. Then only there is a point of running the business. Otherwise, the business will incur loss. That means the minimum return which the business earns on its investment must be equal to the cost of capital. Otherwise, it will incur loss. So cost of capital is that rate of return which must be earned on the investment. Next, it is a minimum rate of earning or the cut-off rate for capital expenditure. Whenever business expends money on capital expenditure, the minimum rate or cut-off rate is the cost of capital. If the company is earning less than this cost of capital, then the company will incur loss. So it is the minimum cut-off rate which must be earned on capital expenditure. This is the meaning of the term cost of capital. Now, importance. This cost of capital is very, very important for the company because it is in capital budgeting decisions. Capital budgeting decisions are the investment proposal decisions. So before making the investment in capital projects, the company has to evaluate how much return we should get from this capital expenditure. So how to take this decision? The company will calculate what is the cost of capital. Suppose the cost of capital of the company is 20%. Then the company will say that we are investing in a capital project, we must get at least 20%. If we are going to get less than 20%, we will not make the investment in capital budgeting. So in capital budgeting proposals, cost of capital is very important factor to take decisions on capital budgeting. Secondly, designing corporate financial structure. See here, a company will have different sources of funds. A company will raise the funds from equity, preference, debentures, loan, etc. There should be a proper combination of all these funds. That is called capital structure. An appropriate capital structure will increase the earning of the company. So in making an adequate, appropriate capital structure, we must know the cost of capital. Next, deciding about the method of financing. If new funds are required, then the company has to decide from where we should raise the funds. Should we raise the funds through debenture or equity or preference? So in raising the new fund, the company must ascertain what is the cost of capital at present. Next one is performance of top management. We can evaluate the performance of top executives by comparing the cost of capital with the return earned by the executives. So performance can be evaluated by comparing the actual performance with the cost of capital. Lastly, other areas. A number of other areas are there, like dividend decision or working capital policies, where cost of capital is very, very important. So overall, we can say the concept of cost of capital is very important for the management for taking a number of financial decisions. That's it. Now, classification of cost of capital. The cost of capital can be classified as historical and future cost. Historical cost of capital means the cost of capital of the present capital structure. Presently, the company is having equity, preference, debentures, loan, retained earnings. What is the cost of capital of the present capital structure? That is called historical. But the management requires a cost of capital which is related to future, not for the past. That is called future cost. That means what would be the cost of capital for future capital structure, not for the present. So from management point of view, future cost of capital is very important rather than past. But the past cost of capital will give us a guide for calculating the future cost of capital. Next comes specific and composite cost. Specific cost of capital means calculating the cost of each source of funds. Calculating the cost of equity, calculating the cost of preference, calculating the cost of debenture. These are called specific cost. And the composite cost means combining all the individual sources and finding out the average cost. That is called composite cost. Explicit and implicit cost. Explicit cost means the cost which is actually paid to outside suppliers, outside supplier of funds. Example, the cost incurred in paying the interest, the cost incurred in paying the dividend. These are explicit cost, out of pocket cost. Implicit cost is an opportunity cost. It is not out of pocket cost, but it is only calculated for internal purpose. That is called implicit cost. Then average cost and marginal cost. The present cost is called average cost, whereas the marginal cost means the cost incurred for additional funds required. The cost required for new funds required is called marginal cost. These are the classification of cost of capital. Now, computation of cost of capital. How do we compute the cost of capital? For computing the cost of capital, two stages are there. The first stage, we have to compute the individual cost of each source of fund. We have to calculate specific cost of each source of fund. And secondly, we have to combine all the individual cost and calculate the average cost. So two different stages are there. Computing overall cost of capital form involve the following. Computation of cost of specific source of finance. So from specific source of finance, we have to calculate cost of debt. It is denoted as KD. Cost of preference capital. It is denoted as KP. Cost of equity capital, KE. Cost of retained earning, KR. These are the specific cost. Now, computation of weighted average cost of capital. This is the second stage. Weighted average means combining all specific cost of capital and calculating a single average cost. That is called weighted average cost of capital. So it is known as combined cost of capital or composite cost of capital or overall cost of capital, means same. It is combined cost of all sources of capital. The weights being the proportion of funds in the total funds employed in the business. Weighted average, not simple average. We have to calculate the weighted average cost of capital. So what are weights? The proportion of each source to the total funds employed in the business. That proportion of weights are the weights taken. Now, computation of specific source of finance. Now I am coming to the first point. How to calculate the specific force KD, KP, KE, KR. So first of all, computation of specific source. First, cost of debt capital KD. It is the rate of interest payable by the company to the lenders. Rate of interest KD, cost of debt. It is the rate of interest payable to the lenders of money. What is the rate of interest? Now, debt is again divided into two categories: irredeemable debt and redeemable debt. Irredeemable debt का मतलब the debt which will not be repaid back. That means perpetual debt. The company has issued the debentures, but it will not redeem it. It is called irredeemable. So for irredeemable debt, the cost of debt KD after tax is I divided by NP into 1 minus T into 100. I stands for interest charges, NP stands for net proceeds on issue, T stands for tax rate. If you want before tax, don't multiply 1 minus T. You'll get before tax. If you want after tax, multiply 1 minus T. This is the cost of irredeemable debt. If the debt is redeemable, that means period of redemption is given. The company issues debentures which are redeemed after 10 years. It is called redeemable. So for redeemable debt, KD after tax is I plus RV minus NP by N divided by RV plus NP divided by 2 into 1 minus T into 100. This formula will be applied for redeemable. So in the problem you have to see whether it is redeemable or irredeemable. If date of redemption is not given, irredeemable. If date of redemption is given, redeemable. This formula you have to apply. I stands for interest charges, RV stands for redeemable value, NP stands for net proceeds, N redemption period, T tax rate. Next video I'll start the problems. The concept will be more clear. Right now you will get just a bird's eye view regarding how to compute the specific cost. Now cost of preference shares, KP, second source. Actually, a company will have cost of preference capital when it is having preference shares. On preference shares, fixed rate of dividend will be payable. But the rate of dividend will be paid only if the company is earning profit. If there is no profit, no preference dividend will be paid. So again, there is no question of after tax preference dividend because Income Tax Act says preference dividend is not allowed as deduction. Interest paid is allowed as deduction. That's why we will have before tax, after tax. For preference, we don't have any before tax, after tax because taxation will not affect the dividend. So it is the rate of dividend payable to preference shareholders. Cost of irredeemable. Again, we have two types of preference shares, irredeemable and redeemable. For irredeemable preference shares, KP is equal to DP divided by NP into 100. KP stands for cost of preference capital, DP preference dividend, NP net proceeds on issue. That's it. This is the formula to be applied for cost of irredeemable preference shares. Now, redeemable preference shares. The similar formula what we have done in redeemable debt. So, similar formula. KP is equal to DP plus MV minus NP divided by MV plus NP divided by 2 into 100. Maturity value or redeemable value, anything you can say. So two sources are explained, cost of debt, cost of preference. Now cost of equity capital. On equity shares, there is no fixed rate of dividend. The dividend on equity shares will be paid only if there is profit. If there is no loss, no obligation. So they are the residual claimants. If the profit remains, then only they will get the dividend. In other words, it is not obligatory on the part of the management to pay the dividend. That means, can the management take its own discretion when it will pay dividend, when it will not pay? If they do like that, then the shareholders will get dissatisfied, they will sell away the shares, the market value of share will come down. So management, it has become indirectly obligatory on the part of the management to pay dividend to equity shareholders. It is difficult to calculate cost of equity because there is no fixed rate. There is fixed rate in case of debentures, there is fixed rate in case of preference. No fixed rate in case of equity. So there is no fixed percentage of dividend which is payable to equity. Equity shareholders are the last claimants. The cost of equity capital is the minimum rate of return that a company must earn on equity share finance. So what is the minimum rate of return that must be paid to equity shareholders so that the market price of share should remain constant, should not decrease? That means the company must pay a minimum rate of dividend, then only the market price of share will not get changed. Otherwise, if the company pay lesser dividend, the market price of share will come down. So what is the minimum rate of return that the company must pay to equity shareholders so that the market price will not get changed? There are many formulas for calculating cost of equity capital. Many formulas. First is dividend price ratio. It is called DP ratio. So how to calculate KE? D divided by P into 100. D divided by P into 100. D stands for dividend per share. P stands for market price per share into 100. So second formula is dividend price plus growth. So D by P into 100 plus G. So dividend divided by price into 100 plus G. G stands for growth rate. So this is the second method. Third method is earning price ratio. K is equal to E by P into 100. E stands for earnings. So here D, in case of DP approach, we have taken numerator D. In EP approach, we will take earnings per share divided by market price per share into 100. The next one is realized yield approach. Realized yield approach says instead of calculating the return of the future, we calculate the return of the past. In the past, what is the rate of dividend, what is the rate of earnings we have earned? According to the past earning, according to the past dividend, we calculate the cost of equity in the present year. That is called realized yield approach. Next, cost of retained earnings. So we have completed cost of debentures, cost of debt, cost of preference, cost of equity. Now cost of retained earnings. Retained earnings are the pluffed back profits. Every year the company will earn some profits. Out of the total profit earned, some part will be paid as dividend to shareholders and some part will be retained by the company. The part of profit which is retained by the company is called retained earnings. It is the internal source of funds. It is the internal source of funds. If the company requires funds, it can externally procure or it can internally use our own funds. So internal retained earnings is an internal source of finance which our own money is utilized. So it is better to use internal source because there is no explicit cost incurred. There is no flotation cost. Our own money we are using. So in other words, there is no cost of capital because we are not paying it. But it is wrong. Actually, this retained earnings belongs to shareholders. The shareholders have foregone their profit in the form of retained earnings. So we have to calculate the opportunity cost, implicit cost of these retained earnings. How much the shareholders would have earned on this money which is not given as dividend to shareholders. How much return they have foregone. The shareholders have foregone the money. That foregone money, that rate of interest, we consider it as KR. But it is difficult to calculate KR. Why? Because of two reasons. The shareholders have to pay tax on the dividend income. Now, if we keep retained earnings, they are not paying the tax. Similarly, there is no brokerage paid on purchasing the new security. So, the KR will be calculated by using this formula. KR is equal to KE into 1 minus T into 1 minus B. KR cost of retained earning, KE cost of equity, T, tax rate. B stands for brokerage cost of purchasing new security. This is, in this way we calculate cost of retained earning. So I have explained you the meaning of the term cost of capital, the importance of cost of capital, the classification of cost of capital, and the computation procedure of cost of capital. So regarding computation of cost of capital, we have two stages. In the first stage, we have computed the specific cost of each source of capital. That means how to calculate KD, KP, KE, KR. So far I have explained you how to calculate the specific cost of capital. After calculating all the specific cost of capital, now we have to calculate the overall cost of capital, or weighted average cost of capital, or composite cost of capital. Now I am going to explain you two concepts. How to compute the overall cost of capital and how to compute the marginal cost of capital. The problems are based on this method, what I am explaining now. But apart from that, in examination, you may be asked to calculate the weighted average cost of capital or marginal cost of capital. So now, first, computation of weighted average cost of capital. It is called WACC, weighted average cost of capital. So this step can be applied only after calculating specific cost of each source of funds. So WACC, weighted average cost of capital, is also known as overall cost of capital or combined cost of capital or composite cost of capital. It is based on the capital structure of the company. That means in the capital structure means combination of all the different types of capital. Equity, preference, debentures, loan, retained earnings, all these combined together constitute capital structure. So WACC will be calculated for capital structure. It may be defined as the weighted average cost of each specific source of fund in the capital structure. So after calculating the specific cost of each source of capital, then only we can calculate WACC. Once the cost of each source of finance is calculated, WACC can be calculated by assigning weights to the specific cost of capital. That means what is the weight of equity, what is the weight of debenture, what is the weight of preference. How to calculate the weight? The weights can be calculated by using the book value weights or the market value weights. Weights means proportion of the funds related to the total fund. Example, the total of all types of capital are 10 lakh and the equity share capital is 4 lakh. So total capital structure, total of all the funds 10 lakh, whereas equity share capital is 4 lakh. The weight we can give 4 lakh divided by 10 lakh, you will get 0.4. So specific weight is 0.4 for equity. Suppose 2 lakh rupees is the debenture. So 2 lakh divided by 10 lakh is 0.2. So this is the weight of debenture. Like that, we have to calculate the weight for each source of funds. Whether weights can be taken as book value weights or market value weights. The computation of WACC can be studied in the following steps. The 6 steps we have to apply to calculate the WACC, weighted average cost of capital. First of all, compute the specific cost of each source of funds. Calculate KD, KP, KE, KR. Specific cost for every source you have to calculate first. Second, assign weights to specific cost. For each source of fund, assign the weight, how much weight we are getting, 0.4, 0.2, 0.3, like that. Then multiply the cost of each source of fund by the specific cost. Now you multiply each source of funds with the specific cost. Then add weighted cost of each source of funds. Weighted cost of each source of funds. Then add the weights. Next step, add the total weights, W, summation W. Then divide the total weighted cost by the total of weights. Total weighted cost divided by total weights. We will get the WACC, weighted average cost of capital. The concept will be more clear after doing the problem. Right now, you simply remember what is WACC, how to compute. In examination, you may get a theory question regarding explain what is WACC. This is the theory. Now, last and final topic is marginal cost of capital. additional cost of additional capital. A business may require additional funds for expansion. Because once a business is set up, when the business grows, it requires more funds for its expansion. Now, finance manager has to decide how much funds should be raised, from which source. So, to calculate the weighted average cost of capital for additional funds, for new funds, it is called marginal cost of capital. So simply, marginal cost of capital is the weighted average cost of capital for additional funds which are required in future, not present funds. Additional funds which are required for future expansion, that is called marginal cost of finance. So companies may raise additional funds for expansion. The finance manager may be required to calculate additional funds to be raised. The cost of additional capital is called marginal cost of capital. The marginal cost of capital is the weighted average cost of capital for the new capital by calculated by using marginal weights. That's it. So in this video, I have explained you completely about the cost of capital, importance, classification, and what is the computation procedure. The first step, computing the specific cost of capital. Second step, computing the WACC. Specific cost of capital, how to compute KD, KP, KE, KR, I have already explained. Then how to compute WACC, weighted average cost of capital, and marginal cost of capital. Inshallah, next video I'll start the problems on this financial management.